So, the Eurozone crisis, the debt crisis, is apparently schizophrenic, or at least the markets and the headlines in response are schizophrenic. Take a look at this. First, I want to show you the front page of today's Financial Times, which says, if we have the ability to zoom in on that, says markets undermine Eurozone rescue bid. Let's look at headlines from a little later today. All right, let's bring up Bloomberg. Stocks rise in part because of Italy vote. So now stocks are rising because of the Eurozone crisis. And let's go to another one later from the Financial Times today. Said markets rally as Eurozone debt fears ease. Okay, so in a few hours, apparently the entire situation changes. So let's put this schizophrenia aside and the obsession with what every investor or trader's move means and figure out what's really going on here. And we have just the guy to help us do that. Michael Pento, president of Pento Portfolio Strategies, says he's gotten it right on Europe. So let's hear what he has to say. Michael, it's nice to see you.
Well, it's not me that says I got it right. Isn't it anybody who's listened to me would say that?
Okay, just real briefly so you can toot your horn. What have you gotten right?
Well, I said that European bond yields would skyrocket, and they have.
Okay.
I said that this Eurozone crisis would metastasize, and it has. But I don't want to seem like I'm bragging, please. I don't want. It's not the kind of person I am. Let's start all over again. Let me tell you how lovely
Come on, Michael.
You look. I want to tell you how lovely you look with glasses.
Oh, well, thank you. Okay, let's move on from that. I don't know how to respond to that, but I appreciate it. That's very nice. Way to throw me off here. Let's get back to those bond yields you were talking about. You said they would rise. They've definitely risen. Let's talk about Italy, because now people are suddenly calmed by the fact that they have gone down below that 7% threshold. There's rumor that it's because the ECB has stepped in. First of all, do you think that that rumor is accurate?
Of course it's accurate. Mario Draghi has threatened to carry a bazooka, much like Hank Paulson threatened to carry a bazooka, which, as you will remember, was supposed to rescue Fannie and Freddie. And remember, if you carry a bazooka, according to Hank Paulson, you'll never have to use it because it's all about confidence. It's not about confidence. It was about insolvent nations. It is about insolvent nations in Europe. And it was about a housing bubble in the United States. So when you carry a bazooka, all that means is you're going to have to fire it. And they fired the heck out of it at the housing market, hasn't done anything. And guess where Fannie and Freddie went? You want to pull up a quote on Fannie and Freddie?
Yeah, Fannie and Freddie are still sucking billions and billions of dollars and aren't really being dealt with, and still have an unlimited paycheck from the U.S. Treasury until 2012, the end of it. Back to Europe, though. So you're saying that basically Italy is no better off today than it was a few days ago when its yields were above 7%.
Well, here's my problem. I've got many problems, but here's my problem with the Eurozone. So Italy has 2 trillion euros in debt. Their debt to GDP is 120%. They aren't growing. So, you know, when you own the debt of a nation, you like to be able to believe that you can get repaid at some time in the future. Well, the bond market in Europe started in Greece, and now it's went to Italy. It's going to Spain and even France, Portugal. The bond market is saying, I'm not going to get repaid my principal, and hence I'm going to desire a much higher interest rate, a much higher coupon rate on my bond. So interest rates went from almost 3.5% a year ago to 7.5% in 1 year. So the bond market in Italy and in Greece, by the way, Greece 2 years over 100%, they're telling you that they're not going to get paid back their principal. Not me telling you, it's the bond market. So here is how, and the hubris of Wall Street makes me nauseous. Almost makes me want to go down to Occupy Wall Street. Actually, Occupy the Fed would be much more appropriate. But here's the arrogance and stupidity of Wall Street on both sides of the Atlantic. So the central bank prints money, massive amounts, hundrds of billions of euros, and buys Italian debt. Yes, they are doing that. Make no mistake about it. And so yields have come down, you know, albeit on the margin, from 7.5 to 6.5 today. But let me ask you this. When you buy a bond, Lauren, you want what? A real after-tax return, which means you want to factor into inflation. How could you print money and create inflation and bring yields down forever? Can't happen.
Can't happen. I don't know. U.S. yields are going down pretty low, but that's another situation. I don't want to get into that. I want to get into French bond yields, actually, because we're seeing them being heavily affected by what's going on in Italy. But I want to look back a little bit further. I want to bring up a chart for our viewers, if we could, because I want to show how you can see that drop in French yields in summer of 2010. And that's when there was a lot of turmoil in Greece, and Greek yields were spiking, and everybody was running to French bonds. Now you see, in response to Italy, French bonds are spiking. Now, this is something that Michael, me and our producer, Dimitri Kofinas, who you know, have been talking about today. And I want to bring Dimitri into the conversation because I know he wants to ask you a question about this. Dimitri, fire away.
Hey, Michael, how's it going? So my question has to do exactly with that. What we saw was in the French bond market, we saw yields drop preceding the ultimate bailout in Greece, which was an indication that people were seeking safety in French bonds, along with German bonds and perhaps U.S. Treasuries. But this time around, we're not seeing that. We're seeing the opposite reaction. And to me, the concern there is that people no longer view France as safe. And France is part of the core, and the core is supposed to bail out the periphery through the FSF and these bailout funds that rely on this artificial AAA rating. What sort of threat do you see for France and for the core of Europe and ultimately the Eurozone? How quickly do you see that possibly developing as a form of contagion from Italy to France?
Well, you're right. It went, like, as I claimed in the beginning, the European debt crisis was metastasizing. It started in Ireland and Greece, then went to Italy. Now, the only two countries that have any semblance of solvency were France and Germany. But, you know, their debt as a percentage of GDP is close to, I think it's 83% in Germany. So it's not like they don't have any debt, and there's a limit to how much they can fund the EFSF. They are not willing to, and they are not able to fund or properly fund and leverage up the EFSF. The only way you can do that is through massive monetization of the euro. And as I explained to Lauren, who I'm sure understood completely, is that when you create inflation by its very nature, it's a matter of physics almost. You drive prices down and yields higher when you create inflation. So I'm not at all surprised that French bonds are starting to revolt, and I would not be surprised to see Germany right on the heels.
There you have it. So you think Germany is the next place we could start to see bond yields spike as this continues to go on. Michael, there's so much more I want to get to with you. So hold that thought. Hold that thought. We're going to come back. But first, I want to actually explain to our audience what it means to monetize bonds, like you just mentioned. And I want to talk to you more about all of this just after a short break. That's Michael Pento. And we'll be back with him in a minute.